Hey everyone, and welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. If you've ever found yourself totally tangled up in the complexities of consolidated financial statements, specifically when you're dealing with struggling subsidiaries, well, you're in exactly the right place. Today, we're going to break down a really practical, highly relevant accounting scenario so you can walk away with a rock-solid grasp of the mechanics. Let's get right into it.
Now, our analysis today is actually pulled straight from the 218th edition of the Gap Advisors Task Weekly newsletter. This is put together by C.A. Manish C.A. Iyer, director at Gap Advisors, and it's published over on LinkedIn. They've actually put out over 230 editions so far, so if you're on LinkedIn, I highly recommend hitting subscribe on that newsletter. It's completely free and honestly a total goldmine of knowledge.
Okay, before we do the heavy lifting, let's just lay down a few quick ground rules. First up, the views we're discussing today are personal views of the author, so they aren't legally binding. Definitely seek out an expert's help before making any big moves based on this explainer. Second, our functional and presentation currency here is the Indian rupee, or INR, meaning anything else is considered a foreign currency. And finally, our reporting period runs from April 1st to March 31st. Make sense? Awesome.
So, here is our roadmap for today. We'll cover the holdco-subco dilemma, the consolidation principle, impact on group profit, passing the journal entries, impairment testing the CGU, and finally, how to join the Gap Advisors network.
All right, let's kick things off with Section 1, the Holdco-Subco Dilemma, a tale of two ledgers.
Picture this. You've got a parent company, let's call them Holdco, and it's not wholly owned subsidiary, Subco. This setup brilliantly highlights the core of our problem today. When you look at their separate books side by side, it's like looking at two completely different realities. See, the subsidiary is struggling, huge losses, and because the advances and investments look pretty much unrecoverable, Holdco has fully provided for these advances and completely impaired its investments in its own separate financial statements. But, and here's the kicker, if you look over at Subco's books, there's absolutely no write-back of these advances. Its share capital just sits there looking totally normal. So we got this massive disconnect between the two ledgers.
Which brings us to a really burning question, one that honestly traps a lot of accountants and auditors. When we actually bring these two entities together to prepare the consolidated financial statements, how on earth do we reflect this provision for doubtful or impaired advances? Like, what's the actual treatment? And more importantly, does that corresponding credit just go straight into retained earnings? Well, let's find out.
Moving right along to Section 2, the consolidation principle, elimination.
To solve this little puzzle, we have to look directly at paragraph B86 of C of Ind AS 10. And the standard here is crystal clear. It literally says you have to eliminate in full intergroup assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group. Basically, the whole principle of consolidation means you've got to completely offset and wipe out those intergroup transactions, right? You only report the transactions that are happening outside the group.
So, what's the logic behind this elimination? Let's break it down. In the consolidated financials of the Holdco Group, the investment in the subsidiary, plus any advances to them, have to be fully eliminated. No exceptions. Because of that, the provisions on those exact investments and advances that Holdco recognized in its separate books, those have to be fully eliminated too. Now, since this is an elimination adjustment happening right at the consolidation level, the impact has to go into the exact line item where it was originally booked. So if Holdco recognized the provision in the statement of profit and loss, you have to adjust it right back there in the statement of profit and loss. Meaning, the answer to our question from earlier is a hard no. There is absolutely no direct credit to retained earnings.
That brings us to Section 3, impact on group profit, visualizing the shift.
Now let's look at how this theory actually impacts the bottom line, because this is where it gets really interesting. Let's anchor this with a super simple example. Say Holdco made an impairment of 100 rupees in its separate books for investments. Naturally, Holdco's standalone profit drops by that 100 rupees, right? But because Subco hasn't touched this in its individual statements, the whole thing remains an intragroup transaction. So when the Holdco group actually sits down to prepare the consolidated financials, they have to reverse that 100 rupee impairment. This means, and this is wild, you actually credit the consolidated profit and loss by 100 rupees. The group profit literally goes up to the exact extent of the provision and impairment made in those standalone books.
All right, on to Section 4, passing the journal entries, the mechanics.
Let's look at the actual plumbing here. First up, the elimination of the intragroup entries for those provisions. We are going to debit the provision for impairment of investment in subsidiary account, and we also debit the provision for impairment of loans and advances account.
To balance all this out and to reflect that profit impact we literally just talked about, we credit the consolidated profit or loss. Boom! We're reversing the provisions and restoring the profit right at the consolidated level.
Okay, next we tackle the standard entries for the consolidation itself. We debit the equity share capital of subco account, and we debit the borrowing account, but specifically only to the extent of loans actually given by holdco. Then we credit non-controlling interests, credit loans, and credit investment. This whole sequence neatly combines the entities while completely stripping out that messy internal overlap. Now for a very important pivot. Section 5, Impairment Testing the CGU, the crucial caveat.
So you might be thinking we're done, but hold on a second. Just because we reverse that intragroup provision doesn't mean the group is totally off the hook. We still have to satisfy the rules of Ind AS 36. See, because the subsidiary is bleeding money, with significant losses, those losses are a giant flashing indicator of potential impairment. So the holdco group still has to test the cash generating unit, or CGU, of the subsidiary for impairment. If the carrying amount of that CGU is higher than its recoverable amount, well, the assets belonging to that CGU absolutely must be impaired in the consolidated financials. It's a two-step dance. You reverse the intergroup provision under Ind AS 110, but then you might still need to recognize an impairment based on the real-world value of the underlying assets under Ind AS 36.
Finally, let's wrap up with Section 6. Join JAP Advisors Network, Resources, and Next Steps.
Everything we unpack today is pulled straight from the massive issue repository over at gapadvisors.com. Guys, this platform hosts over 4,500 issues and detailed responses on Indian accounting standards and Indian GAAP. And the best part? Anybody can register completely for free. Once you're in, you can actually submit your own issues on Ind AS and Indian GAAP, and you'll get a detailed expert response delivered straight to your email inbox. It's an absolute game changer, especially for auditors who really need to formally document exactly how they tackled a tricky Ind AS application issue.
Also, if you're the kind of person who likes to really deep dive into these topics while you're commuting or on the go, you have got to check out the GAAP Advisors Ind AS Clinic podcast. You can stream it on Spotify, Amazon, or right here on YouTube for a full audio deep dive into the exact scenario we just walked through in this explainer.
So let me leave you with this thought. When you're putting together your next set of financials, are you absolutely sure your consolidation entries correctly navigate the strict elimination rules of Ind AS 110 while still respecting those rigorous impairment tests of Ind AS 36? Definitely something to think about. Anyway, thank you so much for your time today. If you found this explainer helpful, please go ahead and hit that like button, drop your thoughts or questions down in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. And please share this explainer with your contacts, your colleagues, your audit and finance teams, and especially any students pursuing their CA course. It really helps us spread the knowledge of Indian accounting standards. Until next time, keep learning.